In spite of the correction that has happened in the mid and small cap space, the valuations do not seem feasible.
You need the trade deal to be signed as the single biggest change that needs to happen.
Do investors need to start looking at these two commodities more seriously in investor portfolios?
370 of those stocks have not made money or lost money for their investors.
Is there a belief that you have strongly held on to?
India is actually slowing down. Is there a crash?
Next question is more on the customers' portfolios. We have been favoring small cap stocks and small cap mutual funds. Sundaram Small Cap was also one of the mutual fund that we used to highly recommend earlier. Since 2000 and 2018. So from the correction of 2018-19, since we saw value in small caps, we've been recommending it, and we have been recommending it even till today. But in spite of the correction that has happened in the mid and small cap space, the valuations do not seem breathable even at the moment. And a lot of fund houses have commented on the. A lot of fund houses have stopped accepting lump sums in small caps even now. And my question to you is, should small caps continue to be present in investor portfolios, especially aggressive portfolios, those customers who have investment horizons for the next 5 to 10 years in the form of both SIPs and lump sum? Will the benefit of small caps in wealth, in terms of wealth creation that we've seen over the past 5 years, will that continue in the long term as well over the large cap space?
So the first thing there is that remember that small caps are high beta stocks. In a positive growth economy stock market, they will rise faster, and the reverse is also true.
Yes.
And one of the factors which is not very popularized in the media and not enough focus is given, but fund managers are telling you that through their actions, is that India is actually slowing down, not growing fast. Lots of people putting over, India at 8.2 fastest growing country in the world, blah, blah, blah. The real number to look at from a stock market perspective is the nominal GDP. That has steadily declined from a 12% level down to budgeted 9.9 to actual 8.7. So the low inflation is actually hurting because the FIIs, when they bought large caps, right? Up to September last year, September 22. Okay. And when they started selling, they were selling large caps and larger mid caps. Fund managers, because of this awareness and knowledge, started buying those large caps.
Yes.
So wherever they had flexibility. So only to the extent that they had a small cap fund with 65% of which had to be put in small caps, they bought small caps. Wherever they had the flexibility, they tilted that portfolio towards large caps.
Towards large caps, yes, yes.
So if you see a 1 year return, I think the large caps are at about 5% the mid caps are probably flat, the small caps are down 8%. So clearly fund managers are voting with their actions and not buying small caps with whatever liquidity they have got. So, right, the domestic DIIs have put in 2.5 times that FIs have pulled out.
True.
But what means that they have bought large caps even more than the large caps they sold. That's why Sensex is stuck at 85,000, right? Because the DIIs have been supporting it. But the fact of the matter is, when the economy is in this kind of a slowdown from a nominal GDP, the small cap, high beta companies, which earnings-wise also get affected more. High beta starts from the earnings perspective, that when the economy does well, their earnings rise faster than the nominal GDP of the country. When the economy is slowing down, they fall faster in terms of relative growth. So that's exactly where the small caps are today, that though they are growing, and that's why if you see, and you were talking about the Sensex to me, but you take the Nifty 500, I read a report that 370 of those stocks have not made money or lost money for their investors. So very polarized. Whatever we have said in terms of a flat mid cap and some marginal large cap performance is only from that 130 odd companies who have contributed to that kind of return. 370 companies have not. So clearly, in a slowing economy, small caps are going to get hurt. Over the last year, the government has done a lot of initiatives to boost private consumption.
Correct.
The income tax cut, the GST cut, the RBI's rate cuts have all, in a way, while it's positioned as boost consumption, it's actually reinflating the economy.
Okay.
Because only when nominal GDP starts rising will that percolate down to a small cap's EPS is also
Profit earnings.
right. The expectation is in the next year that there will be a rebound in the earnings from this year in the market, led by small and mid caps, followed by large caps. So if that plays out, then small caps will recover from the correction they faced this year. But does it mean that they are yet on the growth path? For that, we need more hard economic data to come through on the growth in our economy. So to that extent, what this then tells you is you don't need to go and redeem your small caps, but to add fresh, you add it staggered and you be patient. Don't expect an overnight recovery, but when the recovery happens, they will then bounce very fast. But the timing of that recovery is very hard to predict. And right now, fund managers are actually not yet changed their thought process. They're still supporting the large caps. They will change only when they see the earnings grow. The January earnings season, hence, is very crucial because all these efforts of this year 2025, you will know in the January quarter earnings as to how far is it translating into EPS growth, margins, and all of that. Because the GDP number for this quarter will be published much later. Plus the GDP print when it comes out is when you get a clear direction whether in 2026 small cap earnings are really going to grow at the rate expected by the valuation.
So I'm going to take you 2 years back. This was when you had come down to New Delhi and it was a cold January morning in 2024. We were giving a presentation on Sundaram Asset Allocator, multi-asset fund at that time. So, and that was the time when small caps were still running. And the point that you just mentioned, you had mentioned to me at that time as well, कि small caps बहुत ऊपर चले गए हैं. यहाँ पे people have to take a pause because now what FIIs are going to do is they are going to start pulling out of India and they will pull out from the large cap space. So when a fund manager sees valuation in the large cap space, where will they put money in the large cap space from? They will redeem their small cap profits and they'll put it into the large cap space. This means small cap में correction आएगा. And it did not happen for 1 year. Till January 25, that did not happen. And January 25, then your prediction came true. So I want to ask you as a follow-up to that story, is there a belief that you have strongly held on to, which the industry did not, which was completely contrary to the industrial view? ऐसा कोई belief था इतने सालों में, ऐसा था तो वो क्या था? Did that turn out to be true or not?
I think that was true for a very brief period of time in the COVID phase, where the severe correction that took place in the March March 2020, right? Since I'd already seen the GFC crisis play out and how that happened, I was very apprehensive that the COVID thing, again as an international, would hurt India for a prolonged period of time. But the markets bounced back very strongly, very quickly. So I was wrong there because I had been burnt by the GFC very badly. So it was there in my DNA. So when COVID happened, again, all right, I felt that this was going to be a prolonged crisis. It was a prolonged crisis for the world, but the markets bounced back despite COVID having phase 1, phase 2. Markets bounced back very fast. Whereas in the global financial crisis, that didn't happen. The crisis was there and the markets also corrected for an extended period of time. So I was caught on the wrong foot. In the post-COVID recovery, right? I think that I thought that this is going to be another GFC repeat in terms of both the economy and the markets. But the markets proved me wrong and they bounced back fairly sharply post because of the massive liquidity infusion that all countries did. So though there was still a liquidity infusion which happened in the GFC, and then later when I analyzed, I realized that in the GFC, Indian economy was not so badly affected, and hence Indian government did not infuse any liquidity or do any action. Whereas in COVID, India was also affected, and hence India also took a lot of liberal liquidity-related infusion, which helped the markets. So I think the big difference was, so the learning for me was that be clear about whether the crisis is purely an international one or an international plus domestic one. And when it's international plus domestic RBI plus government will take adequate action to protect.
Measures. Another key learning, another key lesson. My next question is going to be around again on customers' portfolios. So here I'll share an interesting experience. So this was 1 year back while I was working on the portfolio construction of a lady who had just moved from India to Canada. And she called me up on a Sunday evening and she told me, Shalini, my portfolio is not performing well. And I was a bit shocked. So on a Sunday evening, I thought to open her portfolio and check whether I had indeed missed out on something. I checked and her portfolio was showing a 30% CAGR. I asked her that your portfolio is showing a 30% CAGR in the past 3 years. So this seems like a good performance. Why are you disappointed? She said, but the portfolios of my family members and various friends are showing 32%. So it's a bad performance. What is wrong with the portfolio? Can you please check if certain changes are to be done over here? So the point that I'm trying to make is that investors have been so convinced and so used to with 30% kind of portfolio CAGRs that the current investments, that the returns that have come about in portfolios since the past 1 year and are highly disappointing to them. So my question to you is whether investors need to adjust their expectations now, or such portfolio returns will come back to them again in the future?
The reason those kind of returns happened was India went from a huge change in terms of awareness of equity investing and mutual fund investing over the last couple of decades. That additional burst of liquidity, the SIP book being an example, the Provitt accounts being another example, the fact that the provident funds were allowed to allocate a greater proportion to equity, the fact that the NPS scheme got things, so that money also came in. These were all the changes that took place over the last 2 to 3 years. So that fresh flow of equity, combined with the fact that FIIs were then still enchanted about India till September last year, gave that fantastic return because there was a sudden splurge of demand for stock, right? And since then, what has happened is that Indian economy has slowed down, right? FIIs have not been so interested, but this surge of domestic liquidity has made that the markets don't fall. So you will make 30% returns again if the markets go through a severe correction. Then the bounce back will be 30%.
Yeah.
Right? So if what you asked me a few minutes ago about will there be an AI-related, bubble-related stock market, I might believe it's not. But I have been proved wrong in the past, so I could be proved wrong again. Is there a crash? Those people who invest at the time of crash will experience a 30% return. But those who are already invested, those who are putting money now, expecting a 30% return because there is no addition. Now, what is the change that's going to happen in India? We are going to see improvement in our GDP growth with all the government efforts.
Yes.
We are going to see the FIIs return someday. We are going to see the trade deal being signed someday. These are the positives. But all these positives are only going to enable you to get, I would say, a decent double-digit return. So a 30% kind of a return expectation from the current levels of the market. It will be possible only if the market significantly corrects because of that happen. But I don't see that happening. That's my personal view. So hence, expecting anything above 15 to 18% is not right. So your best return portfolio cases over the next medium term would be the 15 to 18% is what you benchmark customers as a best return scenario. So that effort has to be done by all of us in the industry, right? To that extent.
So India has a very strong fundamental position today. You can look at any macro indicator, whether it's the inflation, although inflation is a little below our target figures. It's GDP, whether it's inflation, whether it's the GST tax collection on a month-on-month basis. So the macro positions are very, very strong. However, while DII book continues to be sizable, we are still putting in about 30,000 crore on a monthly basis. So my question to you is, what are the FIIs seeing over here that they are not putting in the money? Is there something that the DIIs are missing out on that the FIIs continue to see?
Seeing that India's future growth prospects of going up from the current levels to a 10% GDP growth, right, are going to be extremely difficult if a US trade deal is not signed. Both DIIs and FIIs are able to see that future, but DIIs are unable to do anything about it because customers are giving them the money. They can't return the money to the customer. They can't build up their cash beyond the next point of cash balance.
Right.
So they are forced to deploy it. They have to keep deploying. So to them, the relative valuations within sectors, within stocks is all that matters. But they have to put their money to India. But FIIs have a choice of putting money into China or South Korea or Taiwan. So the difference is that both have the same worldview, that a trade deal which is reasonably positive to India, right, not tilted overly to the US in terms of how the deal turns out, is important for India to achieve those next levels of thing, which will make FIIs come back. But for DIs, it's the same amount of money that they're going to be putting. There's nothing changed. The DIs have to buy X, Y, or Z. There's no India's good macro means that FIIs are not pulling out even more money, right? But for them to put in more money, you need the trade deal to be signed as the single biggest change that needs to happen. But if you want to get a 15-18% return from the Indian markets, you need FII money to come back in a much bigger way than just 5,000-10,000 crores. And that will happen only when, because for a simple reason, the US is 30% of the world's GDP. The US per capita income is $90,000 per person. We are at below $3,000. India has to go and sell its products to a market which is 1/3 of the world and which has 30 times the purchasing power of its people. So if that market is shut out for India, in the absence of a trade deal, you're not going to get to 10% GDP growth. You can maintain this 6.5, 7 average, yes, but that's not good enough for FIs to come back. Our 6.5, 7% growth is already taken into account. If the macros turn bad, there'll be even more FII pull out. Because all this GST expenditure, that is, right, whether the government is going to sacrifice income this year. So what's the fiscal going to look like will be known only in the budget. In the long run, they're expecting that the increased consumption would mean increased GST collections and it will compensate for the reduction. But will that happen for the 6 months of this year? All I'm trying to say is that the view for India is the same for DIs and FIIs. FII is able to act on that view. DIs are unable to act on that view.
A lot would come to be known in the next two quarterly earnings, whether the GST rate cuts as they eat able to give the corporate earnings a boost or not.
Correct.
In the past 5 to 10 years, we've seen, and we've also advised investors to maintain 5 to 10% allocation in commodities. While commodities have been, specifically gold and silver, they've been highly volatile. However, due to the recent geopolitical circumstances and the central banks across the world buying gold, we have seen gold and silver rallying. Gold has rallied by more than 60%. Silver has more than doubled in this year itself. Do investors need to start looking at these two commodities more seriously in investor portfolios?
Yes, I would recommend 10 to 20%, which is a doubling of the previous. Because what's changed here is that that's why I would separate out precious metals from commodities. Commodities go through their cycles, right? So 5 to 10% exposure to commodities is good enough because you don't know when the cycle is good and bad. But gold and silver are going through a complete resettlement phase because of the loss of faith in the US dollar. Due to Mr. Trump stance of MAGA and being very inward. He's put out money from WHO, he's put out money from this. So he's clearly looking inward. So people, and the Russia-Ukraine crisis where US froze Russia's dollar assets. The rest of the world is wary about putting more money into dollar, saying if things don't work out well between the two countries, they could end up freezing our dollar assets. And the third thing is that the de-dollarization process unfortunately can't be played through a currency like the BRICS currency because China and India, I don't think will really get together to form a currency. Yes, trade within the BRICS countries could be in local currencies. Okay? But what I mean is that there's no alternative currency to the dollar. So it's going back to gold, and because gold ran up a lot, it's coming to the poor man's gold, which is silver. So I think that this move of central banks to slowly, they don't want to do dramatic moves. So they are gradually accumulating gold and silver in their reserves. So will continue through this year and to next year. Because unless Mr. Trump finishes his term and a new, more Obama-like president who's more looking at US as a world leader, which is opening its markets to the world, as long as Mr. Trump's thinking said, it's going to be very polarized. So free trade is no longer going to be right. So to that extent, the move against the dollar in favor of precious metals will continue. Now, that doesn't mean that you're going to get another 50% return in gold or 50% return in silver, but there will definitely be a competing asset class among international allocators. So they will give decent returns. So I think that sitting in India, we have to allocate to them, because the second factor which supports that is that the prices of these metals are fixed in London Metal Exchange. So which means that when it translates to India, the currency is weakening, straight away comes as a return to your portfolio. So there's a gold return in US dollar and then a gold return in rupees. So last 1 year, rupee has devalued 7%. So that means from your investment in gold, you got another 7% apart from the gold price appreciation. So in the future, rupee may not devalue 7%, but the laws of fundamentals say that 2.5 to 3% depreciation over the long run is something for the rupee to live with, right? So which means that your gold and silver will give you the 2 to 3% currency related return, plus add another 7 to 8, 9, 10%, you still get double digit returns from gold and silver. So when there is a asset class which is looking like reasonably giving a double digit, and when I'm equities also, I'm saying only double digit, albeit a little better than gold and silver. But then why do you ignore a double digit return asset class? So I would say that at this point in time, you should double that allocation from 5 to 10 to 10 to 20% to gold and silver.
At the same time, investors also have to be wary with the kind of volatility. Because,
no, but that's so, as if equities don't have volatility. So I'm saying they are anyway equity investors, they are used to the volatility, but they are more tolerant of gold's volatility than of equity volatility.
Okay. But staggered investments or lump sum investments?
No, always I would say staggered investments, and I would say multi-asset allocation funds are your best way to play, because the volatility there can be played by the fund manager in a better way. I would say multi-asset allocation funds come with 20% allocation to gold and silver. So they are a good way to do that. So I would suggest that as a better bet in terms of rather than directly buying so much of gold ETFs or silver ETFs or physical gold bars.
Okay. And my final question to you is going to be on the summary of all of the learnings that you've had throughout your career. If you were 25 and with all of the knowledge that you have gained over these years, and if you had to start your financial planning, what would you do differently?
So what I would do differently is decide my exit date before my investment date. So every single investment that I put, I will have clarity around what am I doing it for, how long am I willing to be patient with it, and write that down. Because part of my bad decisions have come from wrong buying decisions, but a significant part of my bad decisions have come from wrong sell decisions.
Selling decisions.
So getting that selling decision away from a market-related selling decision to a goal-related selling decision, right? And you can fix that goal as 3x. I want to triple my money. You can set that goal as I want to buy a Mercedes-Benz car. So when my portfolio grows to the value that the inflation is a Mercedes-Benz from the day I start investing and my portfolio matches, I will ruthlessly execute my sell order and buy that Mercedes. So goal-related planning, which I defined, but actually goal-related planning is nothing but deciding the basis on which you will redeem your investments. I think that's, if I were to start life over again, I would make sure, because then a significant proportion of my investments would have been successful in my mind because I achieved that goal which I had set right at the beginning.
Yeah, that very well aligns with one of our key fundamentals of financial planning. Have clarity on what are your goals and how long are these goals for, and then accordingly make an exit. All right, Mr. Sunil Subramaniam, thank you very much for coming over to our show and giving that wealth of knowledge that you've accumulated over your lifetime to our investors. It was indeed an honor to have you on our show. Investors, thank you very much for watching. We will be coming back to you with more such sessions on With Provitt. Thank you very much. This is Shalini Gera, and bye-bye.